Well, good afternoon or good morning to you, depending on where you're sitting in Australia, and welcome to today's Moo presentation, 2025 Outlook, and a look ahead at the US earnings season. Now, some of you may have joined us in December for our 7 Themes webinar, where we talked about what we saw as 7 key themes for market performance over 2025. Today, we're looking at an update on those themes and a look at the market story so far for each of those themes that we've identified. And we're going to add extra material here by also having a look at the US earnings season, the quarterly and yearly reporting season that got underway this week and will continue for the next few weeks, giving us a good gauge on the health or otherwise of the US share market. My name's Michael McCarthy. I'm the Chief Commercial Officer here at Moo Australia, and I'm here with our globally renowned market strategist, Jessica Amir. And together, we'll be looking at those 7 themes and the US earnings reporting season. So settle back. Today's session will go for 1 hour. Because we have so much material to cover, unfortunately today there'll be no Q&A session. But if you would like to read subtitles to this webinar, either in English because you can't pick up my Australian accent, or in another language such as Chinese, you can do so by going to the settings cog you'll see next to the window there and changing your language settings to the language that you'd like to see subtitles in. So with that housekeeping out of the way, let's move on to some very important information. And I would urge everyone, please, to read this screen. First thing to note is that Moo Australia is licensed by the Australian Securities and Investments Commission, and you can see our Australian Financial Services licence number on the screen there, along with our Australian business number. Perhaps one of the most important pieces of information on this sheet, though, is that investing involves risk. Risk and reward are tied together, and those who seek market rewards are taking risks. And this, another important aspect of this information is that today's presentation has been prepared with general information. We don't know your personal situation. And as investors and traders, we all come to the market with different goals, different amounts of capital, different risk appetites, different timeframes. And all of these differences mean that the right decision in thinking about investment and trading depends as much on your individual situation as it does on the market. So please remember, all of the information today is general in nature, and the decision as to whether or not any of this information applies to your situation is a matter for you and you alone. So that's for you to decide. If you have any doubts, particularly about the key elements of risk involved in investing, or any other matter here, you can consult our financial services guide, or if that doesn't clarify the matter for you, please seek independent advice. So today we'll be looking at the 7 themes that I mentioned, plus the US earnings outlook. We'll start by looking at ETF investment trends. And this is one of the major long-term trends in the market, the move towards the use of ETFs for investment and trading purposes. And Jess will identify some of the key trends within that major, more than 2-decade-long trend, and point out where the markets have been heading last year in 2024 and where they may go in 2025. She'll then look at the artificial intelligence boom that drove so much of the share market action last year, looking at those stocks and the sector overall that was most affected by that boom in artificial intelligence technology. I'll then have a look at one of the important factors in assessing the outlook for the market, and that is the expectation of, at this stage, a US Federal Reserve interest rate cuts, but it's that future direction of interest rates that's very influential on markets everywhere. And of course, where the US market goes, the rest of the world tends to follow. The US S&P 500 index is the most influential index in the world, and the expectations around interest rates in the US feed into its performance, and therefore the performance of just about every stock market in the world. I'll then have a look at the potential impact of one of the factors that the new president in the US has identified, and that is the potential for the introduction of tariffs on other nations, those doing engaged in trade with the USA. And we'll have a look at the potential for those tariffs and what impacts any potential introductions of tariffs might have on the markets. Jess will then look to the Trump trade that we've discussed previously. We've identified a number of key instruments that are affected by the new presidency of Mr. Trump, and Jess will highlight a couple of those that may represent market opportunities for those that are so inclined. She'll then move on to look at the Bitcoin phenomenon, and it is truly an investing and trading phenomenon, and the potential moves that might occur over the course of 2025. I'll then come back to have a look at the local perspective and the potential for the Australian share market and certain sectors. And I've even identified one stock for you today that you might want to consider in the context of your investing and trading activities. And then we'll turn to the US reporting season and have a look at some of the major trends. And Jess will identify one of the most important sectors that we're looking at as we move into that US quarterly and annual reporting season. So sit back. I hope you've got your lunch with you. It is a BYO lunch situation as advised, and we are aware this is a lunchtime for many Australians. So sit back, enjoy your lunch, and we'll move into the body of the presentation. Jess, would you like to kick us off with the current trends in ETFs?
Well, I hope everyone is having a very good lunch indeed. And thank you very much to those of you who have been chiming in on the Moomoo community with your comments and feedback and questions. Keep them coming. Michael does hold a weekly webinar, and of course we endeavour to answer some of your questions or most of your questions on the Moomoo Loan Premium tab, which we regularly engage with. But let's just get to the ETF trends. So as Michael said, without a doubt, investors and traders are increasingly using ETFs to take a view of the market. And if we just think about the most popular ETF that's been traded globally, it amassed a record amount of funds under management last year. And of course, without a doubt, that begs the question, what is that ETF? Obviously, it's the SPY. The SPY has continued to dominate. But all in all, the entire ETF industry took in a massive $1 trillion of new money last year, just astronomical. That's a record, and that's something that you probably might expect to increase this year. But what's really important to note is that on Moomoo, investors and traders are actually using ETFs not only to take a view on the market, but by far the most popular ETFs that are traded on Moomoo are single stock ETFs, such as NVIDIA. So if investors right now believe that NVIDIA is going to potentially make a run up after it's been sold off in anticipation of tonight's TSMC earnings. Will that deliver, I guess, a much needed pickup in chip sentiment that's been, I guess, a little bit downbeat? That is a thinking. So we're starting to see investors buy into ETFs that have got leveraged exposure to NVIDIA and other semiconductors such as SOX. But that is just one theme taking place in the ETF cohort that we do believe you should consider watching. But by far, the most important popular global instrument was the SPY. Other instruments traded on Moomoo that we believe will probably continue to gain interest are VOO and IVV. And so these are very popular because remember, guys and dolls, the S&P 500, the reason that it garners so much flows each quarter is because of institutional flows, fund manager flows, superannuation flows, but it's also the only index in the entire world that you can only get into if you've had 4 consecutive quarters of profit growth. So there's a good reason why, regardless of all the bear markets that we've had throughout history, which Michael and I have lived through some. Michael, perhaps a little bit more than me.
That is true. I don't know why I'm laughing. That is true.
I may have a few grey hairs in my eyebrows, but not as many as you.
All right, let's move on, shall we, Jess?
But yeah, really worthwhile to note that the SPX, VOO and IVV are increasingly being used as trading vehicles. Just before we skim through the rest, the second most popular ETF trend taking place last year that is probably going to, I guess, take in an unprecedented amount of flows this year is Bitcoin ETFs. So overnight, in case you missed it, and indeed today in the Asian Pacific session, I just saw Bitcoin rise back above $100,000 US for the second time in history. So I guess momentum is pretty hot ahead of our Trump's inauguration next week, given that Bitcoin is maybe going to be added to the US Strategic Reserve list. So that is something to consider. Keep an eye on Bitcoin ETFs such as IBIT. The third most popular ETFs are, of course, the QQQs. We mentioned those this morning in our morning note. The QQQs, the NDX, if you're down under in Australia, the NDX are increasingly popular investments to track the NASDAQ 100. Of course, the NASDAQ 100, the biggest tech stocks in the US. Fourth most popular theme, Michael, and for those of you who might be falling asleep into your lunch, the fourth most popular theme, buying into Chinese ETFs. That is something to consider. But by far, Moomoo investors do love to maximize their gains, getting those double or triple digit gains in stocks like Nvidia or SOX. But I hope you're still awake. We do have one more theme to go through before we hand back over to the man of the hour with all the jokes. I'm just here for the ride. AI. So let's quickly talk about AI. So we touched on it last year, and the theme remains basically the same. However, if you did pay attention to that AI conference that took place some 2 weeks ago, you might believe that the AI wave could indeed get even bigger this year. So the AI revolution, if you haven't considered a potential position in AI, now may be an opportunity for you to start being seriously adding some AI investments to your portfolio if that's what you're after. So if you have a look at consensus estimates, AI stocks are still expected to generate some of the strongest returns in the market this year. It's all for good reason. At the AI chip market, the average company, I guess, is increasingly, if I can say that a little bit differently, the AI chip market is expected to see $1.3 trillion of spending by 2032. What does that mean? That means companies like the businesses that Michael and I are sitting in today, perhaps the business that you're sitting in, wherever you are, is expected to increase the amount of spending in IT towards AI. So that's something for you to consider. So, you know, if you rewind 10 years ago, AI spending made up 0% of a company's budget. Fast forward out to 10 years, that's expected to be a 10% spend of your company's spending to go towards AI chips. And it's because companies really want to increase efficiency. They actually want less bums on seats in some aspects, in some departments. Automation is expected to really mainstream manufacturing, the food and agricultural sector. But that's why NVIDIA has been a key beneficiary of that. Of course, NVIDIA, the biggest seller of AI chips in the world, and there's a good reason. They briefly became the world's biggest company last year. But we have seen their shares move up 3% overnight. But of course, they don't report earnings until much later down the track. But we'll get other chip earnings along the way, and that'll probably beef up NVIDIA if we do see some earnings beats. Palantir is another stock that you should be keeping on your radar. Palantir is gaining a record amount of sales, $10 billion in the pipeline, and most of that is, of course, AI deals. So the AI bandwagon is not just, NVIDIA is not a one-trick pony. NVIDIA is not the only benefactor of AI spending. It also is not just about chips, is what we're saying. It's about software. And then it's also about the data center companies. And of course, the last prong to consider is the companies that are selling uranium to the data centers, such as Constellation Energy. So there's many stocks that fit into the AI benefactor thinking model, but encourage you to reach out to either of us on the Moomoo platform. They're just some considerations. But let's go back to Michael. So last night we saw US inflation, CPI actually came down.
Yes, it did. The core inflation rate came down from 3.5% to 3.2%. And just as you know, that's very, very important. A lot of headlines were captured by what's known as the headline rate, which actually rose, and that might have concerned some investors. But we know that the US Federal Reserve focuses on the core rate, and the core rate fell, and that's a positive for markets. The Federal Reserve is very wary of the potential to spike inflation. In fact, a small uptick in inflation late last year saw the Fed change its rhetoric and the market change its expectations for rate cuts over the course of 2025. Because if inflation moves away from the Fed target rate of 2%, it makes it very difficult for the Fed to become more accommodative, because at the heart of their mandate, their dual mandate, is jobs and prices, and price stability is very important to their outlook and their actions. And so if inflation is heading higher, that is a real impediment to any further rate cuts. We have seen the markets back away over that last part of the year. And it's not just the short end futures that look at cash rates that have backed away. The whole bond curve has moved significantly higher. 4 months ago, the US 10-year bond was trading around the 3.7% mark. Today, it's trading closer to 4.7%. And that big 1% gain for the 10-year bond is a very big move in bond markets. And it just goes to show how much thinking around interest rates has changed. Now, since the GFC in 2008, the interest rate outlook and the actions of central banks have driven markets. We've seen a lot of bull markets that have been accommodated by central bank action to support economies, and in doing so, supporting share prices as well as other assets. And that big rally that we saw after the COVID sell down was largely due to expectations that the central banks of the world would come to the rescue of the economies and the asset prices of the globe. And that's exactly what happened. Whether we look at the actions of the People's Bank of China, the US Federal Reserve, or the Reserve Bank of Australia, all of them acted to accommodate what was a very low growth outlook due to the pandemic lockdowns. As they passed, of course, interest rates rose again. The central banks took back some of the accommodation they provided because of those concerns about inflation. In 2022, we saw a huge outbreak of inflation around the world, and that really caused central banks to stomp on the brakes in most cases and lift interest rates back to what we might consider more normal levels. Now that curtailment of inflation has largely been achieved. We've seen inflation here in Australia and around the globe trending downward again. There's a lot of expectations for further cuts in interest rates. However, there are two factors to consider in this. First of all, in emergency situations like the global financial crisis of 2008 or in the pandemic lockdown era, in emergency situations, the Reserve Bank, the central banks demonstrated that they were prepared to go to extreme measures. That is, to reduce interest rates to zero and flood the global monetary system. And the impact of that was to support assets all around the world. Now that we're moving back to a more normal economic outlook, there should be some doubts that the central banks would do the same in the absence of an emergency. And yet that wasn't the case. In the middle of last year, there was a lot of excitement about the potential for a reduction in interest rates in the US, for example, from the current levels around 4.35% to below 3%. And despite the Fed speeches around this and other central banks around the globe, like the RBA, saying that they didn't think that there would be any hurry to rush rates down again, I think implying that they didn't see an emergency and they would not move back to the emergency levels that they set during those previous crises, the market remained very buoyant around the idea that we'd see further rate cuts. And while it's likely central banks will continue to move rates depending on the economic outlook, and particularly for employment and for prices, the idea that they'll immediately lower them right down to accommodative levels as soon as there's any signs of concern about the economy might be overblown. The other important factor to remember here is that central banks worked in a coordinated way. Now, they deny they were coordinating, but there's no doubt that there was communications between the central banks, and they all took very similar stances in those emergency situations. But what we're seeing now is a divergence amongst central banks, with the Bank of Japan, for example, maintaining a tightening bias despite the easing bias of other banks. And that's an important clue for investors. It seems much more likely, in the absence of emergency, that central banks will continue to respond to the individual country's situation. And so inflation readings in each nation and growth readings in each nation and employment data in each nation are likely to be the three elements that central banks focus on rather than what the rest of the globe is doing. And that's a change in behaviour that some investors have never seen before. So it's likely to be a different world for central banks. Now, we've seen this in the expectations, and if we've got the slide here of the expectations, you can see what happens here is that we're looking at an implied forward interest rate, and that interest rate is implied by the pricing of futures markets. Professional interest rate traders use these interest rate futures markets to hedge their exposures for the coming year, and we can reverse engineer them to look at what the crowd overall is estimating the probability of rate cuts. And as you can see from this slide, right down there on the bottom right-hand side, the expectation is by the end of this year that interest rates in the US will be around the 4% mark. Now, that's a huge change from previously. Just 4 months ago, that expectation was for interest rates by the end of this year down around the 3% mark. And it's one of the reasons why we've seen a bit of a slowing in the enthusiasm for shares. Now, looking at the US market, let's bear in mind we've seen better than 20% returns 2 years in a row, 23 and 24, and that's not a common occurrence. For Australian investors who are in the US market, that return was boosted by a falling Australian dollar. If you invested in US dollars and the Aussie dollar falls, the value of your US dollar investments is also going up. And many Australian investors achieve returns of around 40% by taking unhedged exposures in US stocks. Now, past performance is not a predictor of future performance, and that may not happen or anything like it again this year. But it is interesting to note that that great performance was captured by those who dared to go to the US. So the outlook for US interest rates is not only important to the US economy and US investors, it's very important to Australian investors, and particularly those who had the prescience to get into US shares 2 years ago. So a positive outlook continuing, and potential support for the market from that benign interest rate outlook. A less benign outlook, though, however, is the potential for the introduction of tariffs by President Trump and the Congress in the US. And this is a major concern for the world, because to reiterate what we saw in 2017 and 2018, nobody wins in a trade war. And introducing tariffs on various nations, the threatened 25% tariffs on Mexico and Canada, the threatened 60% tariff on goods from China, and a blanket 10% tariff on everybody else, as well as perhaps special consideration for European markets to see even higher tariffs, is a concern for every investor around the globe, because these sorts of trade barriers, while they might introduce temporary benefits to some companies, tend to really slow the global economy. And in the interconnected world that we live in, with global trade a daily occurrence, anything that throws sand in the gears of the global economy is likely to cause at least hiccups in share market performance. So the introduction of tariffs would certainly be a concern. But militating against that is the fact that the tariffs that were finally introduced in 2017 and 2018 were not as bad as had been promised on the campaign trail. And once again, we've had some big promises on the campaign trail before the election in November last year, but whether or not they'll actually translate to policy remains a very open question. And what we saw previously was that these threats of the introduction of tariffs were used as a bargaining chip in international trade negotiations rather than being brought in preemptively. And I think it's reasonable to suspect that that might be the case again, that these are a big stick with which to threaten trading partners to get better terms for the US. So time will tell how this goes. Jess mentioned before that the first day of the Trump presidency is next week, the 20th of January. And it's thought by many, given the rhetoric that's come out of the White House since the election of Mr. Trump as the new president, that there could be some major moves to set the tone for his administration on the very first day. Now, looking at a list that was prepared by a group called Axios, there's something like 53 actions that were promised as first day events. It's very unlikely all 53 of those will be implemented. But it's also very likely that Mr. Trump will look to set a tone, and markets will get a much better idea of how aggressive Mr. Trump is going to be generally and on this key issue of tariffs on that day next week. So January 20th or the morning of January 21 for Australian investors will be an important time to be paying attention to any announcements coming out of the US. Tariffs are a concern. They're a reason to be cautious, and the potential introduction could be very bad news, especially if major economies like China and Europe retaliate with tariffs of their own. That could lead to a protracted trade war that hurts everybody. So we are on alert, and it's one of the risks for the year. And one of the things we have determined already this year is that volatility rose in the lead up to Mr. Trump's election in November. It has continued to stay at elevated levels with a little dip over the holidays, which is a very normal behaviour. But that higher level of volatility speaks directly to risk in the market. And risk management is always important in investing and trading, but in higher volatility environments, it becomes even more important. So tariffs, a potential source of volatility and a good reason for every investor and trader to have a look at their current risk management policy and make any changes that might be necessary, given that this year is likely to be more volatile than last.
Absolutely. And we'll be covering the events that follow and what announcements we see from the 20th or the 21st, depending on what region of the world you're in. So stay tuned to Mumu. We'll be covering that, as will our global team as well. But on one hand, we do have tariffs. On the other side, we do have sanctions as well. So also keep an eye out on sanctions, particularly in the chips. We spoke about chips, NVIDIA earlier, TSMC earnings tonight. So we are expecting, based on what Trump has already said, and what Michael just alluded to, you might be expecting some announcements in terms of those chip producers that are not US firms. So the benefactors will obviously be those firms domiciled in the US. The losers might be those companies in offshore, such as those companies in Taiwan and China and the like. That's just a consideration. As we said, more detail next week for you. But for now, let's just think about, I guess, Trump's second term, what else it can mean, and some key potential stocks that can benefit. So we just spoke about chips. The second prong might be to think about what is one particular instrument that you might want to focus on to just trade or just to keep on your radar. Well, here's one to wet your whistle. Just to reiterate what we said last year, Tesla. So I personally believe that that Tesla will be one of the biggest benefactors of Trump in the White House. We'll find out next week what that actually means. He is expected to now maybe even take a position in the White House. We'll find out. Of course, we already know he's been tapped as the head of Doge, but it's not just Elon Musk and Tesla you should keep an eye on. Jeff Bezos will also be invited to the inauguration, so keep an eye on Amazon. That's a potential another stock to watch. Be really interesting to see what other tech leaders are invited to the inauguration next week, so keep an eye on that. But all in all, Trump's second term in the White House is expected to invoke more M&A, more IPO activity, of course, cutting of red tape, and I guess deglobalization means a shoring up of US company profits. Does that mean earnings could maybe be upgraded? Let's wait and see what happens from next week. But so far, we have started to get earnings out of the US, and we'll touch on that in a couple moments. But for now, let's just bring up the chart of Tesla. We saw Tesla shares jump 8% overnight. So a very big swing up. So what on earth happened? Well, we do know I guess the transportation elected new Treasury head, if that's a very long waffly title, and I probably got it wrong, but he came out and said that he's going to make it much easier for full self-driving in the US. So this basically signified what a lot of analysts and traders have been waiting for. We could potentially see Trump's administration approve full self-driving in the US. Of course, we know we've been speaking about it being approved in China. So if this happens for Tesla, it'll be a huge game changer. We were reading some months ago that Bloomberg has estimated that FSD, full self-driving cybercab division, has got a multi-billion-dollar valuation. That's according to Bloomberg in itself. So that's excluding Tesla's EV sales. So the market is basically saying expect good things if we do see Trump and Elon Musk's relationship basically bring in the approval of full self-driving. The second thing is their cybercab. Cybercab is expected to maybe be approved sooner than expected. And the other thing that is expected to benefit Tesla is, of course, over the last couple of weeks and months, they've cut the prices of their Model Y down under here in Australia, which is really good news. They did that at the weekend. And last week in China, they revised their Model Y and also cut the price of that Model Y as well. But Tesla should be on your radar. A lot of clients actually use leveraged Tesla ETFs to take a view on Tesla moving higher and inversely lower when we saw Tesla pull back. So do have a look and explore the leveraged ETFs in Tesla that a lot of our fellow Moomoo investors have been trading. That is something for you to consider. But do keep in mind that Elon Musk has very quickly grown to become the world's richest billionaire. So he's exceeded $400 billion in net worth. So just phenomenal stuff. And it was really thanks to Trump getting the vote last year. So we'll wait and see what happens once he's in the Oval Office next week. So do keep an eye on Tesla's stock. Obviously, we've been speaking about Bitcoin. The second thing with Trump's term in the White House, that obviously means you should be keeping your eye on Bitcoin and Bitcoin-linked ETFs and Bitcoin-linked stocks. Now, we've put up a chart here of MicroStrategy. Why have we done that? For those that haven't been following MicroStrategy, MicroStrategy has quickly become the largest corporate holder of Bitcoin in the world. So we do know last week they bought over 2,500 so of Bitcoin, which is just astronomical given that we just said Bitcoin is back above $100,000 US. Thanks very much. But that's by the by. But if you do think about Bitcoin or Bitcoin ETFs, as we were saying at the open, IBIT, do keep an eye on that. If we do see next week, maybe Trump's administration actually say, Bitcoin, let's make it a key reserve asset. Let's buy it on our balance sheet like we buy gold and the like. What does that mean? That basically means if proposals are correct and if this comes to fruition, that the administration will be looking to buy 1 million Bitcoin. So that's basically $100 billion worth over a 5-year period. And as we said last year, they're basically looking to do this, if it comes through, to prop up the price of Bitcoin because they're going to limit selling. And obviously at a time when the US government is buying, if they continue to buy it on their balance sheet, they already hold 200,000 Bitcoin. If they buy more and go up to 1 million, then there'll be effectively arbitrary, is that a word?
Yeah, it is now.
They'll be pushing up the price of Bitcoin really to offset their skyrocketing US debt levels. And Senator Loomis said this last year, and Robert F. Kennedy Jr. also backed that proposal as well. So what we're saying is basically key takeaway, keep an eye on IBIT next week, other Bitcoin-linked ETFs, also keep an eye on MicroStrategy, given they now own 2.2% of the world's Bitcoin currency. So they're just some of the key trends that we think you should be watching. But Michael, down under, there's plenty to watch here in Australia with Australia's market, I guess, continuing to up the ante off some fresh lows. But what else should we be watching down under in Australia?
Well, it's a fascinating time for Australian investors as well. And with the Australian share market touching another all-time high in December, we are much closer to those all-time highs than we are to the lows. And so while the momentum is definitely positive over the medium term, there are some concerns on a valuation basis. However, we're far from alone in being near all-time highs. As we all know, the US market is also there. I think the S&P 500 hit more than 55 record highs over the course of 2024. And although we did see a bit of selling at the turn of the new year, that turned around last night with that news on inflation, and the markets moved back into positive territory for 2025, meaning that the upward trend is still in place. Now, trends persist longer than we think, and that could be the case in Australia as well. But for those investors who are a little concerned about the performance of some sectors and the good gains that we saw last year, and of course what I'm talking about here is the finance sector, and in particular the big four banks, that great performance with gains of more than 30% for each of them is an extraordinary performance. And remembering that they pay a reasonably higher dividend yield with franking credits attached, investors in Australian banks had a terrific year last year. But that meteoric rise has introduced some concerns, particularly as it comes through some of the largest stocks on the market. CBA, the number one market stock by market capitalisation or share value, rose by more than 30%. Now, that's an extraordinary situation, a very happy one for those who are holders of CBA and the other big four banks, of course, but that has led some investors to take some profits or at least get a little nervous about the outlook for that sector. As we know, the banks and finance companies make up around 1/4 of the value of the Australian market. Another quarter of the Australian market is comprised of the resource companies. We're talking about the metals and mining stocks and the gas and energy and oil and other energy stocks. So it's quite possible this year in the Australian market we might see only modest gains at the index level, but the drivers of those gains changing substantially over the course of the year. And one of the reasons I'm drawn to those major sectors, the metals and mining stocks and the gas and energy stocks, is expectations in these sectors, in contrast to, say, the technology sectors, are very low. The expectation is that we'll see falls in iron ore prices, that we'll see falls in global liquefied natural gas markets over the course of this year. Now, that's in direct contrast to the health we're seeing generally of economies. There are some economies that are growing slowly, but there are others that are looking at long-term average rates, and some even growing at well above long-term averages. And that growth outlook is very important to physical commodities. And so the modest outlook we're seeing for many of these commodities is, in my view, in contrast with the outlook for the economies. Now, something has to give here. Either the economies will perform more weakly over the course of this year, or those commodity prices are likely to surprise a lot of people who are expecting downturns. And one of the I think undervalued aspects of the AI boom is that all of this huge new computing power needs rare earths to make the chips. It needs copper to deliver the information and the images and the video that comes out of AI. It also needs a lot of steel and concrete to build, for example, the nuclear plants that will be needed to power the data centers that will hold the AI capabilities. So there is an impact on the durable goods, on the tangible goods world from this boom in AI, as well as on the technology sectors. And in my view, that's being undervalued at the moment. I also like the idea that many of the resource stocks have underperformed over the course of this year. In my mind, that puts them in a better valuation situation. Their valuations are nowhere near as stretched as some of the more glamorous sectors and some of the top performers of 2024. And for that reason, I'm favouring those sectors, the resource sectors, but also the industrial sectors, because I think there's overall the big shift in focus for investors towards technology has meant that the hard assets of this world have been neglected. And bulk commodities, of course, speak directly to that. So I'm looking for a better performance from iron ore markets at the moment than is currently being forecast by the forward curve for iron ore. But I think there are others where the expectations have become far too modest, and copper is one that springs to mind. It's also a major component, for example, of batteries for electric vehicles. And while there's been a big focus on lithium, not much has been said about copper, particularly given a number of key mines going offline over the course of 2025. I'm also very interested in the outlook for gas. What we're finding here in Australia and is happening around the globe is that some of the expectations that we've been able to switch our electricity systems to entirely renewable sources has been proven incorrect. All of these renewable power grids, and we're definitely moving towards that in this carbon dioxide constrained universe, all of these sources, particularly solar and wind, are unreliable. They're intermittent. That is, they can't be relied on to provide baseload power. And when it's dark and the wind's not blowing, we need another source of power to fill in, to firm the electricity grid. Now, the electricity grid has to be kept in balance. If it gets out of balance, it goes down. And so that firming power is not only important for those times where the sun's not out and the wind's not blowing, it's important for the stability of the energy grid overall. Now, it was envisaged here in Australia that we would use so-called green hydrogen to firm our electricity system, that we'd use excess electricity on sunny, windy days to generate hydrogen, and then on days when wind and solar weren't delivering, we turn to that hydrogen and convert it back into electricity. Now, while that is still theoretically possible, the departure of so many important players in green hydrogen from this space, including Fortescue-owned energy company, has, I believe it's called Squadron Energy, is that right? Yeah. Squadron, and a number of other players, particularly in the US, moving away from their green hydrogen plans, suggests that while it might theoretically be possible to do what was expected, it's not practically possible. It can't be done at a price that makes it viable. And that means other firming agents have to be found. Now, in Europe, except for Germany, and in the US, they've turned to nuclear power. But one of the options, of course, would be gas. Now, a lot of people are not keen on that idea of keeping gas on. In a carbon dioxide constrained universe, however, gas is the lowest source of emissions and might make a natural choice, particularly here in Australia, where we have abundant reserves of gas that have been untapped because of restrictions on exploration. And so if we start to get blackouts either at the height of summer right now, when people are turning on air conditioners, or in the depths of winter when things get cold, if we start to get blackouts, the political will around gas might shift even more substantially. It's already started to change. But if it does, and if we see the East Coast shortages that the regulator has predicted for this year come to fruition, we might see gas come back on the agenda. And that's why I'd like to look at this chart of Beach Energy. Now, Beach Energy is a very interesting energy company. It has gas reserves in the Cooper Basin and in the Bass Strait. And both of these fields are largely thought to be almost tapped out. The life on these gas wells that Beach are running is between 5 and 10 years. And some might say, well, why would you go into a company that has such a short horizon for its production? Well, the answer is you don't want to be paying for production out into the nether years, because there's a real possibility there will be shift away from gas. It's clearly already not popular, but if it's needed, its need might only last for a few years. So if an investor is looking to take advantage of the thematic that gas is coming back, then this might be the stock, because you're not paying for reserves out into the decades. It's only a decade worth of reserves. Interestingly, though, those reserves are both accessible to the east coast of Australia. And that's where we're likely to see shortages. That's where governments are talking about building liquid natural gas import terminals so that they can take advantage of a perceived potential drop in LNG prices over the course of this year. Of course, the cheaper option still would be to take those existing mills and route them back into our energy system. So Beach Energy has the assets in the right place. You're not paying for a long life here or vast reserves. This would be a straight play on a potential redemand for gas. And what I particularly like about this chart is you can see that having hit lows in the middle of last year, we've seen a consolidation period. You can see the share price on the right-hand side of the chart there, trading sideways for an extended period of time before starting what is clearly an uptrend. Now, that uptrend could be headed towards resistance in this stock around $1.75 and then $1.90. And so moving up from $1.40 or so, that could be a significant addition in return to any portfolio and something to be considered as somewhat of a better value contrarian play in the Australian share market. But just to reiterate, the oil and gas sector, I think, is undervalued at the moment. I think resource and estimates of commodity prices for the year are both undervalued. That's an opinion. We're talking about the future here and nobody knows with certainty. But for that reason, I favour those resource sectors. And I think industrial stocks, hard goods stocks, have been neglected by investors in the tech boom and are also in valuation terms in a good position for investors to consider adding in the long term. Industrials, oil and gas, metals and mining, something to look at for 2025 and beyond.
And speaking about 2025 and beyond, company earnings in the US is definitely underway as well. You've got so much to tell us about that as
well. Well, funnily enough, Jess, here's one I made earlier. No, yeah, absolutely. And with the earnings reporting season kicking off this week, we had several of the major players in the banking market report last night, including Bank of New York Mellon, and we also heard from BlackRock. So we've seen some major kick off the season last night. There were a couple of earlier reports, but now we're really underway. And we'll hear from another 6 banks tonight. And then over the course of the next 3 weeks or so, we'll hear from all of the companies in the top 500, in the S&P 500. And of course, we'll be hearing from those stocks that have driven that spectacular performance of the NASDAQ index as well. So this is a great time for investors to check in on the health or otherwise of the companies that they're invested in or looking to invest in. We sometimes get asked, why is earnings season so important? And the answer to that one is quantitative, it's mathematical, because study after study has shown that the surest predictor of share price movement, either up or down, is changes to earnings expectations. If analysts and investors are revising upward their estimates for a company, it's more likely than not that the share price will follow, will move up. And similarly, if they're slashing their outlook for a company and slashing their earnings outlook, it's more likely that a share price will fall. So that's why there's such a focus on earnings. And in the US, of course, while here in Australia we report semi-annually, in the US they report quarterly. So investors in the US get a regular check-in on what their companies are up to. And of course, if a company doesn't report within the required time, it's suspended until it explains itself. So it's a way of keeping companies honest, and it's a way of keeping investors informed. But more than that, it's speaking to the thing that most contributes to share price performance. And for that reason, it's of use to every investor. Now, you'll note that I said expectations, not the earnings themselves, but the expectations for earnings are the key. And that's why we like to look at what the expectations are before we go through what might be delivered. And this chart here shows you just how accurately, in most cases, earnings forecasts predict the direction of earnings. Now, you can see over the course of this 15-quarter period or 16-quarter period that there were falls in earnings and there were gains in earnings. But in 15 out of those 16 cases, the direction that was predicted by the estimates was correct. So when we see these estimates, although the quantum might be higher or lower than the overall estimate, and remember, an estimate is talking about the future, so there's no certainty around it, but the quantum of it, the direction of it, does tend to give us a clue. So we're definitely expecting earnings growth for US companies overall as measured at the index level. As you can see on the right-hand side, that grey bar is firmly pointing up. And in fact, for the S&P 500, the aggregate expectation here is growth in earnings for the quarter of around 11%. And double-digit earnings growth for a quarter is a very solid and optimistic even prediction. You can see that we've seen big delivery on earnings. Those huge blue bars on the left, however, are the recovery of earnings after COVID. And so we wouldn't read too much into them in terms of long-term earnings performance because of that very extraordinary earnings situation brought about by the pandemic lockdown and the subsequent bounce back. In percentage terms, it looks very dramatic. In real terms, it was nowhere near as dramatic. But on the right, you can see that we've had a trend of growing earnings generally. And after a more modest year last year, we're looking for a further increase this year on the whole for the overall index. Now, the expectations for the NASDAQ are even higher, 11% for all of the companies on average in the S&P 500. For the NASDAQ 100 index, we're looking at expectations of growth between 16 and 18%. So these are quite buoyant expectations. And the reason I harp on about these expectations is because it won't be whether or not we get positive growth in earnings that determines what happens in share prices. It'll be how these companies deliver against the analysts and investors' forecasts of what they might have. So if S&P aggregate earnings come in at 7%, still good growth for a quarter, it's likely that will be seen as a disappointment, and analysts will be revising downward their earnings expectation. And under normal circumstances, I'd expect share prices to fall with that. If, on the other hand, we see delivery across all of these reports of all of the 500 companies of growth in earnings around 15%, that would see analysts revising their earnings upward and investors likely adding to their holdings and boosting share prices. So it's important to know what the expectations are. We've set them for the index. There are a number of factors that could change these substantially, and it's certainly worth paying attention. And on the Moomoo platform, you can see the expectations before the delivery so that when earnings come out and they come through to you on the Moomoo platform, you'll know exactly what to expect in terms of what may happen with the share price. So that's the overall general outlook for the US share market. Jess would like to take a specific look at one of the sectors we've highlighted this time around.
Yeah, absolutely. And I love that you just mentioned the Moomoo platform. I think it's really worthwhile just driving that message home. On the Moomoo platform, we've got something called the Earnings Hub. And this is a great place that Michael just mentioned, that you should be really keeping abreast of earnings this earnings season. Add those companies to your calendar, and then as they report, you can just click on your calendar and it'll take you straight to Moomoo's platform, and you can see the earnings results as they come through. Just to reiterate what Michael said and say it a little bit differently, add some hot sauce to it, you can also see an illustrative view. If the company beat earnings estimates, how much they beat earnings estimates by, and what their profit, how much their profit rose by, and how much it rose by expectations. And as we're alluding to, just to reiterate it again, if a company delivers better than expected goods, then their share price is likely to rally. Inversely, if they deliver sour grapes, you'll see that on the Moomoo platform, again in pictorial view. If they deliver sour grapes, their shares are likely to fall, not only on the day, but in the day prior. But then typically we have found throughout history that poor sentiment can remain for some time, at least a couple of weeks, if we have a look at the history books. So that is something for you to consider. Stay abreast of the Earnings Hub. So Michael just also mentioned banks. So banks indeed kicked off earnings season far better than expected. And overall, the earnings picture is for some overall 12% year-on-year earnings growth for this year. Now, last year, we saw the most earnings growth from what we touched on earlier, and that was the tech stocks. But this year, believe it or not, banks are expected to deliver the goods. And it's astronomical to see the earnings expectations. And overnight, as Michael just said, they delivered the goods. They came to the party, and we saw 6 big banks deliver far better earnings than expected. Why on earth is that? Well, you could argue, hey, there's a pretty low earnings bar to jump over, and obviously when there's a low hurdle to jump over, there's a big surprise for an upside gain in their share price. So JP Morgan Chase, Goldman Sachs, Wells Fargo, Citigroup, BlackRock all delivered far better than expected quarterly earnings per share rising more than expected in some of those banks. So there's a lot of names to keep abreast of, but please use Moomoo's platform. If you could take away one thing from this slide, besides using Moomoo's platform for earnings season, it would be to look at the KBE Banking Index ETF. Now, it appears that has broken out higher on the back of 6 of the big banks reporting better than expected earnings overnight.
Goldman Sachs at 41% increase in earnings last night.
Crazy.
Yeah, I'll say that was eye-catching.
Yeah. Absolutely. That was definitely the standout. Goldman Sachs, an astronomical beat. So really worthwhile tracking some of these stocks that are likely to really prick up the ear on investors' screens. But indeed, it begs the question, will we see more institutional flows come through? And will that drive up some of their share prices? That is something to consider. But it is worthwhile mentioning banking, the financial sector at large, rather, is expected to see earnings growth of some 40% this year. So 40%. And indeed, the banking cohort that reported last night far outpaced that. Now, why is this happening? Just a quick backdrop to set the scene. Not only, as Michael said, cash rates have come up. Not only that, but also banks make their money from bonds. Bond yields have been at 14-year highs. They touched 14-year highs last week. So banks are earning more money from the cash that they've got in the sidelines. But then importantly, as we said, Goldman Sachs, arguably a very large institutional bank, one of the biggest, JP Morgan Chase, the biggest of them all. So institutional business is indeed picking up, trading is picking up. And as we said, we're expecting more IPO activity, more institutional business to pick up, and of course, trading and investing to pick up as well. And that would be for the betterment of this sector. So that is why we do think it should be on your radars if it's not already. Do keep an eye on the KBE Banking Index ETF. That is the biggest banking ETF in the US. Indeed, perhaps an instrument for you to track. Of course, just before we close off on this, banks are obviously a barometer for the health of the US consumer, but also for the US economy. So last night, the read-through of those big banks was really pleasing for investors, and that is probably why not just the better than expected inflation print, but add in the earnings. That is probably why we did see the S&P 500 and the NASDAQ, the QQQ, move higher and erase the losses that were previously made this year. So very assuring signs for investors. The next couple of weeks, indeed 2 weeks, you could argue the equity markets might be more tied to company earnings. And if we see the beats, as Michael said, and as I've said, if we see earnings beats, then you might expect that would support the market, not just the S&P 500, but the NASDAQ, but also down under in Australia. And as Michael has highlighted, we do get Aussie bank earnings, Aussie ASX 200 earnings as well.
I've got to do an ad here, Jess, because next Tuesday at 2 p.m. Australian Eastern Time, I'll be doing our regular Ask a Strategist every Tuesday. And this Tuesday session will focus on the outlook for the Australian reporting season, which kicks off in the first week of February. So if you're particularly interested in Australian stocks, please join us next Tuesday. And after that ad, I'll pass back to the studio.
That is very exciting. Very, very exciting indeed. We've been waiting so long for Aussie companies to report. As Michael said, Aussie companies only report twice a year. So few and far between do you get a look through at a company's war chest or dirty laundry. So it'll be a good chance to see how Aussie companies are faring and what their outlooks are for this year. Very important stuff. But that's basically all we have time for today. Thank you so much for your company. On behalf of Michael McCarthy with all the good jokes, and myself, Jessica Amir.
I'm a father, especially dad jokes.
It's been a pleasure and honour to be with you here for the outlook for 2025 and a look through at bank earnings, also big tech earnings. They also begin to kick off from next week with Netflix kicking off the ranks. Stay tuned to Moomoo. Next week we'll be covering what you need to know after the inauguration, what policies will transpire, what will happen with tariffs. As always, we've got your back here at Moomoo Australia.
Thanks, Jess.
Thanks, Michael.